In my view, based on all the research I've done, there's no question that central bank buying has been far and away the dominant factor that's affected the price, that's driven the price of gold up over the last, let's say, 18 months. I suspect there's been some wealthy families, institutions who are buying physical gold and taking delivery, OTC, over the counter. They're buying the gold, so it's not showing up on reports yet. And they're buying it because they're concerned about, basically the state of the world, if you want. That's the economy as well as geopolitics.
In a recent session, the price of gold continued its upward trajectory, reaching a peak of approximately $2,400 during Asian market hours on Friday. This surge is attributed mainly to heightened geopolitical tensions in the Middle East, with expectations of further escalation. Such uncertainties significantly bolster the appeal of gold as a preferred safe haven asset. Adrian Day, CEO of Adrian Day Asset Management, provides insights into the factors influencing gold prices, highlighting central bank buying as a primary driver. China, in particular, has been actively increasing its gold reserves for 16 consecutive months, outpacing all other central banks in 2023. The People's Bank of China purchased 225 metric tons of gold last year, comprising a substantial portion of the global total of 1,037 tons. Day notes the surge in gold buying among individual investors and households in China, along with potential involvement from wealthy families and institutions acquiring physical gold over the counter. These trends reflect broader concerns about economic uncertainty and the growing demand for safe haven assets. Despite the steady increase in central bank gold holdings, data released last month showed a slight uptick in the bullion held by the People's Bank of China, marking the smallest increase since the monthly purchases began in November 2022. Day underscores the significance of central bank buying in influencing gold prices, noting the intriguing trend of steady outflows from exchange-traded funds despite the rising cost of gold. Global physically backed gold ETFs experienced their 10th consecutive monthly outflow in March, albeit at a reduced rate compared to previous months. Come along as we explore the valuable insights provided by Adrian Day. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
In my view, based on all the research I've done, there's no question that central bank buying has been far and away the dominant factor that's affected the price, that's driven the price of gold up over the last, let's say, 18 months. There's been some changes this month, maybe last month. We'll talk about that in a second. But overwhelmingly, central bank buying has been the predominant factor driving gold. And you could look at various there's other sources of gold buying that are well reported, but you can look at hard facts and statistics. And you look at ETFs, for example, as most people know, gold ETFs had net outflows last year on a fairly consistent basis. But not only last year, even this year, we still have net outflows from gold ETFs. And if you look at the GLD, which is the largest of the gold ETFs, the first major one and the largest, and they report daily on their flows. So yesterday, we had 118,000 ounces net outflows, despite gold being up. That's $268 million went out. And not only that, it's every day this week. We've had net outflows. It's the third straight day in a row. This year, we've lost over 3.5 million ounces just from GLD. So I think we can say, and we look at the global ETFs on a weekly basis, and pretty much every week this year, except the beginning of March, we had net outflows. So we can say with a high degree, not a high degree, we can say with certainty, but it's not investors and small institutions who buy gold through ETFs who are driving the gold price. On the contrary, they're selling. What about retail buyers? You can look at coin sales. Now, there's no one report, but you can look at coin premiums, because premiums tend to go up, of course, when there's strong demand. Premiums are down. I've talked to several coin dealers, both in the United States and in Europe, and they both tell me that up until the last two, and they all tell me, sorry, in both continents, they tell me, but up until the last 2 weeks, it has been steady, consistent selling. of coins, people coming to them to sell coins for various reasons. Some because they like the price and want to sell, but more often than not, frankly, because they need the money, which is a different issue and a bad sign. In the last couple of weeks, people tell me there's been some buying, but it's kind of a wash. Nobody that I talk to is reporting strong net buying of gold. So it's not the retail investor who's buying coins. You can look at other things like the COMEX open interest, and that's gone up a lot in the last month. That's speculators speculating on the COMEX, not buying physical gold, but it still can have a bullish impact on the price of gold, of course. And that is bullish. That is one new factor, but it's certainly not enough to account for the rise in the price of gold. We've seen this year, particularly since the Chinese New Year, if you look at the numbers from the Shanghai Stock Exchange, we are seeing individual investors and households in China step up by buying dramatically. That's not surprising when you think that the sort of things that Chinese people typically buy to protect themselves, the banks are in trouble. They typically buy real estate. Well, real estate's in trouble, and they will buy stocks. Stocks are in trouble, and they will buy gold.
A significant surge in gold and silver prices early Friday has drawn renewed attention to the precious metals market. However, some analysts caution against chasing prices at current levels, suggesting that investors should consider taking profits amid the rally. While gold and silver are still considered in structural bull markets, analysts advise that Friday's spike presents an opportune moment for profit-taking. Nevertheless, the focus on silver continues to intensify, with analysts highlighting substantial value in the marketplace. Silver prices surged to nearly $30 an ounce, marking its highest level since February 2021, with the precious metal recording an almost 6% increase at its session peak. Adrian Day's observation that silver outperformed gold this year holds significance, particularly given silver's historical role as both an industrial and monetary metal. Silver's tendency to exhibit sharper, but potentially less sustained price movements compared to gold adds an intriguing dynamic to consider when assessing investment strategies in the precious metals market. Let's get back to the interview.
I will point out, though, to your silver bugs that are listening, or silver bulls that are listening, silver now actually has outperformed gold this year. So it's not just the last couple of days, but if you go back to December 31, silver's now outperforming gold. And the silver stocks are now matching the gold stocks. They're virtually identical year to date. There's a couple of things about silver. I mean, we all know that silver's more as much an industrial metal today as a monetary. It still tends to move as a monetary metal. But the common wisdom, which I go along with, it's common for a reason, but the common wisdom is that silver tends to have, some sharper moves, but not necessarily sustained moves. And typically silver's move is, towards the end of a bull market. I would like to think we're not at the end of a bull market yet. But I think what's happened with gold over the last, let's remember only 18 months ago, 2 years ago, gold was what, 1,400 or something? Don't quote me on that. But, it's had a dramatic move over the last 2 years. And so we're at the point where people are going to begin to pivot from silver to gold. I mean, from gold to silver, just because of the price differential. And I think that's what we're seeing now. But where silver can really shine, of course, is, and we've seen this in the past. So when silver gets moving, it can move very, very dramatically as people pile on, because everybody can buy, everybody can afford $30 for an ounce of silver. Not everybody can afford $2,300 for an ounce of gold. And so people can pile in, retail can pile in, and the thing tends to be very, very leveraged. I mentioned the demand side of silver, but there's another thing we need to look at with silver that's changed in the last 30 years, 40 years, not just the industrial demand being more important, but on the supply side. 40 years ago, most silver produced what came from primary silver mines. Today, less than 20% of the silver in the world comes from primary silver mines. Some of it comes from gold silver mines, but most of it comes from base metal mines, zinc mines, lead mines, and so on. The supply of silver tends not to respond to changes in the price of silver. That's different for gold. Of course, the response time with gold we're talking a matter of months or years. But still, if the price of gold moves up a lot, people start dusting off projects that are on the shelf saying, can we put this gold mine into production? They go ahead with expansions. They extend the mine life, etc. That doesn't happen with silver because it's coming from a lead mine or a zinc mine. And so that's another reason why when silver price starts to move up, you don't get any increase in the supply of silver. And there's no huge stockpiles of silver yet. Most of the silver, knives and forks and teapots, that was all melted down in the 70s bull run. I don't think at some point, obviously, there's some people that still have silver to melt down, but not a lot, frankly. Banks don't have stockpiles of silver anymore, the way they even did in the 70s. And so the silver price can be very, very responsive and very, very leveraged.
Goldman Sachs recently raised its year-end gold price target to $2,700 from $2,300, citing momentum and a lack of significant retail haven buying thus far. The investment bank highlighted that despite potential headwinds from ETF activity, Federal Reserve rate cuts could catalyze to offset this later in the year. Additionally, Goldman noted the possible impact of the U.S. election cycle and fiscal policies as factors contributing to gold's bullish outlook. How might these factors shape gold's performance shortly? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.